Holy moly, the Federal Reserve flip-flops more than some YouTubers these days, okay? This is crazy. We have yet another flip. Just this morning, a Halloween flip from the Federal Reserve, and it comes essentially on the eve of the FOMC meeting, which starts tomorrow and ends on Wednesday, where we're expected to get the 75 basis point reimage, followed by probably more pain. Listen to this. This is remarkable. First, just 2 Fridays ago, Mr. Nick T from the Wall Street Journal, who's basically deemed to be the Fed's mouthpiece back in the summer, he mysteriously happened to get a text from the Fed that suggested we were going to get the first 75 basis point hike. Well, 2 Fridays ago, he writes this article in the Wall Street Journal that actually led markets to somewhat start rallying a little bit. We saw the S&P 500 and the Dow up 4 days in a row, right? And even though the NASDAQ was dragged down by companies like Facebook, markets were kind of rebounding a little bit on this article. And this article, the main highlights of this one were that the Fed is trying to debate what to do after their next 75 basis point hike. And in doing so, though, they think they have to be very thoughtful about their discussion regarding the pace of tightening because they want to slow down, but even though they want to slow down the pace of tightening, they don't want to do the following. They want to make sure they explain to the public that they're not backing down in their fight to prevent inflation, right? So basically, we got this article that's kind of like, hey, we think rates are going to slow down in terms of the pace of hiking, but don't worry, we're still fighting inflation. And the problem they cite was the following. Markets rallied in July and August on expectations that the Fed might slow the pace of rate hikes. Well, they're about to slow the pace of rate hikes, potentially in December, going from 75 this month here in November to 50 next month. And this article says that conflicted with the central bank's goals because easier financial conditions, in other words, a higher stock market and lower treasury yields, because treasury yields also fell on this expectation, will stimulate spending and economic growth, which basically hurt inflation, right? And listen to this. That rally prompted Fed Chairman Jerome Powell to redraft a major speech in late August. This is his Jackson Hole speech, to basically make it clear that they weren't backing down from the inflation fight, right? Well, today we get a new piece from Mr. Nick T. We're going to jump into exactly what Nick T says right here. Look at this. Cash-rich consumers. It's like literally a complete flip-flop, okay, from this last one. So in the last article, 2 Fridays ago, they're like, yeah, we want to slow down, but we're worried about conveying that and creating a market rally. In this article, what do we get? Oh, well, people are still cash-rich, so we might actually have to hike stronger for longer. I kid you not. Listen to some of the parts of this because they're ugly. And if there's any good news in this article, it is that today is Halloween. We're kind of doing a quiet expiration of the Halloween coupon code. Better pricing than what we'll have coming up here in November. So get in before the whole November madness happens. But anyway. So the debate over the speed of increases could obscure a more important one about how high rates ultimately rise. Look at this. They're basically redefining what markets should be paying attention to. They're trying to tell you, hey, don't worry that we're going to go down to 50 basis points. That's not what you need to be worried about. What you need to be worried about is how high we're actually going to end up hiking rates. In our last summary of economic projections, we suggested that we would hike rates up to 4.6%. But now, other people are saying we're going to have to go higher than 4.6%. And then look what they go on to say after that about earnings, savings, and how high rates could actually end up going. You ready for this? Households still have around $1.7 trillion in savings that they've accumulated through mid-2021, above and beyond what they would have saved if the pandemic hadn't occurred. This is according to the Fed. While the housing market is entering a deep downturn. HDMI, I'm going to kill you. It's an inanimate object, okay? Settle down. Anyway, is entering a deep downturn. The housing market is entering a deep downturn. I mean, again, that'll be an opportunity for House Hack. Boy, I can't wait for us to open the non-accredited round. By the way, there's a deadline for, if you are accredited, to sign your papers today. You could wire by Friday, but sign your papers today. The rest of the economy is so far holding together. And this is actually what the Fed doesn't want, right? The Fed wants everything to slow and sink, not just the housing market. I mean, we know the stock market's come down, but consumer credit card balances are rising. Earnings reports from companies like American Airlines, Bank of America, Coca-Cola, Netflix point to a stronger consumer. This is true. Netflix surprised to the upside with the amount of ads that they had. American Airlines is basically bragging about how strong demand still is going into the fourth freaking quarter. And they say here, this is not the earnings season the Fed wanted to see. Now, this is where they say the upshot, which is not necessarily the good shot, it's just what this potentially means, is that cooling the U.S. economy might require even higher interest rates. Yikes. Listen to this, okay, because they're going to give us their guide in terms of how bad this might actually get. The Employment Cost Index, this is like their favorite index, rose 5.6% last week. This was like on Thursday this came out. This was not good. This was not a good report. And now they're referencing a Harvard economist who suggests that rates might ultimately have to reach 5.25% next year, with the significant risk of topping out at an even higher level, potentially as much as 5.5%, and a recession coming in 2023. But there is more work for the Fed to create one. Now, on top of this, Barclays yesterday suggested that, crap, Bloomberg thinks, and Bloomberg economists think, that Eurozone inflation is going to top out at 10.2%, but because of some leading indicators like flash PMIs and early estimates for inflation in the Eurozone area, we actually think it's going to come in at 10.5%. Well, guess what, folks? Those numbers came out this morning, and they ain't good. The numbers came out with an estimate of 10.7%. In other words, Bloomberg economists thought we were going to be at 10.2%. Barclays revises to a worst-case scenario of 10.5%, and we actually get 10.7% in Eurozone inflation, led by 41.9% year-over-year energy inflation, 4.4% services inflation, non-industrial goods at 6%, food and alcohol and tobacco up 13.1%, and all items excluding energy up 6.9%. Holy frickin' smokes. So what you have here, you got to put this together in sort of a way that just is a little bit dirty. I hate to say it. But what you have here is a situation where the Fed's like, okay, we want to slow the pace, but we don't want the market to rally because that's going to lower treasury yields and increase the stock market, which will lead to more spending. So we don't want markets to rally. We do want to slow to 50, but we're probably going to have to keep at hiking rates longer. And honestly, everything that's happened so far in this market has required more patience, not less. Nothing has happened to the better faster. Everything has happened to the worse side. And it's taken a lot longer for these realizations to actually be made. And that's a big problem because it means that we might not end up with a peak hiking cycle in March, as now expected. We might end up with that peak in May or in the summer, which could mean we do end up at that terminal rate of not 4.6%, not 5%, but 5.25% or 5.5% or 6% on the Fed funds rate. Yikes. That's actually really scary because it could really push mortgage rates. And I hate to say it, because I feel like people think I'm just trying to beat on real estate because I'm trying to sell the idea of house hack. Dude, it doesn't matter how much money we raise for this. This company's happening. This company's going to kick freaking butt. If I have to manage 200 homes, it's easier than managing 500 homes for me, okay? This is going to mean I have more time to sit here and make videos because, I mean, that's going to be a top priority. But holy smokes, like, this isn't good. The Fed is now dropping hints that, oh yeah, not only is this going to take longer than expected, but we might have to go higher than expected. I mean, here's Nick. He's basically your Fed leak dog who gives you a little more insight this morning. Here, listen to him
this
directly.
Fed meeting in the
Actually, this was last morning, but whatever.
Coming days. What are the conversations inside the Federal Reserve right now about when inflation gets better and what they plan to do?
Well, the problem for the Fed is that monetary policy takes time. It acts with a delay on the economy, so you can't see your moves right away. The Fed this year has raised interest rates at the fastest pace since the 1980s. Normally, they raise rates by a quarter point every 6 weeks or so. This year, they've been going at 3/4 of a percentage point. And when you don't have time to see how that influences the economy, it's like barreling down the highway, but using the rearview mirror to guide where you're going. It raises the risk that you're going to drive off the road. And the problem here for the Fed is they can't take a risk of not getting on top of this inflation, because even though the risk of doing too much is a recession, the risk of not doing enough is that inflation just stays high and you have to have a bigger downturn later.
Yeah, this is basically the argument that the Fed has to force a sort of soft recession now, not to be confused with soft landing, because any recession still sucks. Technically, our GDP went positive in the last quarter, but from 2 negative quarters before that. But don't worry, the real recession might actually be coming, as the Fed purposely has to force us into a recession because of this inflation that is just so freaking sticky. And ultimately, they believe, as we see, here in the article, that a recession is coming, but there is more work to do for the Fed to create one. They're literally telling us, oh, don't worry, the recession is coming. It's a real one. Yikes. So buckle up, folks. I don't think we're getting out of this anytime soon, and it sucks.